What's going on, guys? Today we're talking about foreclosures, short sales, and a deed in lieu, what all of that means, and if you've had that happen to you or it might be happening to you, how does this affect your VA home loan? It's important to understand it because you want to ensure that you're going to keep your benefits, and we're just going to walk through all the things that kind of happen with that. So basically, a foreclosure is where you've stopped making payments altogether, and you're basically going to be kicked out of your house by force, right? It's going to basically be a sheriff that's going to come in. It's like a sheriff sale that happens. The bank takes possession of that property, kind of like a repo, and then they're going to list it and sell it on your behalf, which basically they'll be the owners. But if there's money being made on the deal, you're still going to make money after the lender gets all their fees. The other way is what's called a short sale, where you actually are going to work with the lender that you currently have a mortgage with to sell the property at a lesser amount than what the current balance is. So for example, if you have a $400,000 mortgage, but let's say your values of properties are $350,000, well, you're going to work with the servicer to approve a $350,000 sale of a property. Now, we really don't see that anymore. Back in 2008, 2009, through about 2013, 14, a lot of that was happening because values plummeted significantly due to crazy mortgages like no income, no asset loans and stated income, stated asset loans. As we know now, we can't do those anymore. And prepayment penalties, all these weird things that people were basically unknowingly got themselves into, right? That was kind of like a big complaint. But, you know, they've obviously stepped in now and they don't allow majority of that stuff to happen anymore. So at that time, short sales were very relevant because properties just weren't appraising. And then the other way that you can do is what's called a deed in lieu, where basically you call the lender and say, listen, deuces, here's the keys to the property. I'm going to sign over the property to you guys and you guys can go ahead and sell it on your behalf. Again, during the time where property values were much lower than they are today, it was very difficult for people to sell. So they were like, you know what? I just want to leave. I want to leave this property. Here are the keys. You volunteering to do that, right? The thing now in today's environment, it's different because majority of people have equity in their property. So there's really no need to go into a foreclosure unless there's some kind of life event that happens, right? You lose your job, you're just not able to pay for a property. But remember, you can always sell your property to make up for that. And then next week, we're doing a video on if you had any type of a, like during COVID, if you went into some kind of restructuring program, there's a lot of people with concerns right now that they might lose their homes after going into like this repayment plan to skip making payments. But again, we're going to cover that next week. This wouldn't affect you in this case, right? This is straight up foreclosures. Again, you don't make any payments. And you know how that whole piece works, that right? Now let's talk about waiting period. So if you had a foreclosure or a short sale or a deed in lieu and you were late on your payments and you just went through that whole process to sell your property, then you're going to have a 2-year waiting period in order to purchase another property. And there's also some other caveats to that that we're going to discuss. So, and the way that you can actually go around that 2-year waiting period is that if it's less than a year, for sure the VA is not going to allow it. But there is this gray area between 1 and 2 years that you can use the VA home loan, but it is definitely going to be something a underwriter is going to have to review, and this will be a case-by-case basis. Okay, so 1 to 2 year mark, you're in between that. You've attained consumer debt subsequent to the foreclosure, and you've satisfactorily made all your payments on time. And then the other big piece to that is that the foreclosure was caused by circumstances beyond the control of the borrower. That's directly out of the VA handbook. Something like unemployment due to prolonged strikes, right? Being unemployed wouldn't be necessarily something you wouldn't be able to control because they say, well, you can go back. But if you're at a place prolonged strikes cause you to not be able to pay the bills, then that would be an example of what's considered. Same thing with medical bills not covered by insurance and etc. Anything past that. But again, it's going to be reviewed by the underwriter. And also if it's connected to a bankruptcy, right? So you're going through a foreclosure and a bankruptcy, it's going to be whichever is going to be the later date is where the 2-year satisfactory piece is going to be. Now that's VA specific because FHA and conventional loans have much longer periods than VA loans. That's why VA loans, I think, are number one when it comes to that. And I'm going to explain a couple things that go with the what lenders look at to analyze that piece, and then depending on the type of foreclosure, what mortgage product you had is going to affect also how this whole piece is going to come together. So lenders look at what's called a CAVERS report. It's a credit alert verification reporting system. This system is going to show all the debt that you have to the government, which would include things like an IRS lien, student loans. There's also, if you took out a small business administration loan and you defaulted on there, it would also appear on this CAVERS report. So debt that comes up on a CAVERS report would actually make you disqualified from using the VA home loan, which is crazy. In order for to use the VA home loan with being delinquent on federal debt, right? Or then you have to make at least 6 on-time payments in order for the CAVERS report to be in good standing. Some things to note when it comes to this, okay? An FHA loan is a government loan, okay? So if you go to foreclosure on an FHA loan, it's going to affect your eligibility on the VA home loan side, right? Unless it's been satisfied. Either you've paid that money back, whatever it's short, that's really kind of your only choice. Otherwise, you lock out a portion of your VA home loan benefits, which is an hour or so long video just to kind of break through that. If you have a foreclosure on a VA home loan, then you definitely have locked out a portion of your benefits. But let's say, for example, you have a $400,000 mortgage and it's worth $500,000, but you just come to a tough spot where you can't make your payments. You're just unsure on how to sell your property and be able to net some money. Well, yes, you can then stop making your payments. The bank's gonna come in, sell it on your behalf, and then if they sold it for more than you owe after all the fees, then you're gonna actually be good to use the VA home loan. You're just gonna have those lates on your credit report. But there's also a caveat, is that if you but again, this is why you should just go ahead and sell your property, sell it yourself, do something with it so you can reap the benefits, especially if you have a really low interest rate. I would definitely look into doing an assumable mortgage. So someone else comes in, assumes your mortgage, gives you a premium on your money because they're getting such a low rate. That's just something that you'd want to consider and see if that's worth exploring. But again, yeah. But if you owe money to the VA, you can pay it back to get your full entitlement. Otherwise, you're going to have a portion of your benefits to use on purchasing a property. So hopefully you guys learned some stuff today. Please hit the like and subscribe button. I'll catch you soon.